Hello and welcome to another one of our Macro Mondays. It is Monday, the 19th of August, and we have a lot to discuss this week. So the Bank of Japan started doing rate hikes. They only did a 25 basis point rate hike, and the market imploded because of the yen carry trade. So people would borrow yen and then they would invest in assets around the world because there was an arbitrage between the borrow cost in Japan and around the world. And of course, because of the currency devaluation, it was also a no-brainer for a lot of investors. Investors would basically leverage themselves up and then do carry trade, which kind of felt like free money, and it works until that spread basically tightens. And when that happens, people have to unwind the position very quickly. And then that, amongst other things like Warren Buffett selling a lot of Apple and there being some fears around recessions, it created a huge amount of volatility. But actually, as soon as the Bank of Japan capitulated, the market has recovered quickly. And actually, over the last month, 2 of the 3 indexes that we track here from a market perspective are actually slightly up. So the Nasdaq's the only one that hasn't quite fully recovered, but the S&P and Dow Jones have. Not from the all-time highs, but they're very close to all-time highs once again. And then the Nasdaq has a little bit more to go, but it's had some weakness, typically due to the drawdown that we've had in semiconductors, which still is recovering. But this goes to show a couple of things. One thing being that price drives sentiment, not sentiment driving price. As soon as people started buying the dip and buying back into the market, that drove sentiment back to a positive position. People were concerned about recessions. They were obviously having to deal with this Bank of Japan implosion, with the yen carry trade becoming less viable, and then negative sentiment kind of spiraled out of control. As soon as that was reversed, the markets come roaring back. It's very difficult to really understand what's going on here because you get a lot of backwards and forwards on whether or not the US is going to a recession. Clearly, the economy is slowing, but primary indexes like these here, are almost at all-time highs, or pretty much at all-time highs. And that kind of moves us on to volatility. So volatility is what really spiked. The VIX actually went up to almost $66 during this Bank of Japan implosion. It's almost down 4% over the last month. This is probably one of the fastest and most aggressive volatility crushes we've ever seen, where volatility grows very quickly and then has dissipated at such an incredible rate, probably never seen before. Nothing that I've seen in my time investing, but also from all the back testing that I've done and looking back at history at where volatility spikes. The fact that it's been crushed so hard is really interesting. That could be something to do with a very popular trade that has been happening in the markets, but is an interesting one, and it's also potentially very risky. A lot of people actually sell volatility, and selling volatility looks like selling puts on the S&P 500. When you sell a put on the S&P 500, what you're doing is you're basically saying, I agree to buy the S&P at a certain price if it drops. Now, where that gets dangerous is if the market actually followed through and it continued to drop, it creates a lot of leverage in your portfolio. So what would happen is a lot of people would get margin called, because as the S&P drops through the level of which they sold their puts and it continues to drop, then it would affect their margin requirements, and it would also mean they may not have enough capital to actually buy the S&P. The medium term trend, like at least the last kind of 2 to 4 years, it's been anytime volatility gets elevated, which in this case it did very quickly from the Bank of Japan yen carry trade, people will then short volatility, and that actually has a suppressing factor on the VIX itself, but in markets in general. It creates a spring. What you can imagine here is the spring gets tighter the more people short the VIX or short volatility, because it's actually creating more and more leverage in the system. So if then volatility picks up once again, then the VIX explodes. So that's essentially what happened here with the Bank of Japan carry trade not working any longer, and then individuals getting concerned about recession. Buffett obviously selling a bunch of Apple created a perfect storm where volatility, however, people are very used to that happening, then thinking that selling volatility is a good idea. As they sell volatility and people buy the dip, volatility in the VIX comes crashing back down. It would be unlikely that we don't see any more volatility in the short to medium term. We're in quite a volatile stage of the economic cycle. We have elections coming up. We have some concerns around the stability of the banking system in Japan and in China. It's unlikely that there will be sustained low volatility. And actually, with all the people that go in and they short volatility, that actually creates a spring that could potentially create more of these drastic moves upwards in volatility. Definitely something to consider when you're holding equities, because when the market is volatile, it creates a lot of gyrations in your portfolio, and that can sometimes cause people to take actions that maybe they shouldn't be taking. So it's just a really interesting dynamic, definitely worth thinking about. Micheal Burry bets big on China and has over 40% of his portfolio in Chinese tech companies. It's an interesting move. He's been relatively defensive in his portfolio, but over the last 2 or 3 quarters, he's been increasing in positions in Chinese equities, specifically Baidu, Alibaba, and Pinduoduo. Chinese equities have been performing poorly since 2021. And China actually in 2021, they destroyed their markets. They basically made equities quote unquote uninvestable, especially for a lot of international investors. But they basically de-inflated a bubble that they saw, and they kind of took a lot of aggressive actions to make equities unappealing and caused quite a significant crash in equities. And now on a relative basis, they've become extremely well valued. They looked actually on a relative basis quite well valued in 2021, and that didn't stop them from getting absolutely crushed. So Burry sees a lot of value in China right now, despite the slow economy that has been going on for the last couple of years in China. But there does seem to be, from a price to earnings ratio, it does seem to be that Chinese equities could be considered undervalued. The RBNZ did it. They actually cut rates. Now, this affected foreign exchange between USD and ZD, but they went ahead and they cut rates. Since then, there's been a bit more optimism around the fact that there has been a rate cut in New Zealand. From a technical perspective, other than sentiment, 25 basis points doesn't really move the needle in terms of actually loosening these conditions. 25 basis points is basically nothing. All it's really doing is essentially creating a bit of sentiment, and a lot of people now feel like we're at the end of this terrible cycle, and surely now things will actually start to pick up. I don't think it's as simple as that. There are many aspects that go into, whether house prices go up or whether the economy grows and it speeds up. It's not just about rate cuts or rate hikes. 25 basis points from a fundamental perspective is a very small change, but it is helping from a sentiment perspective. And it does mean that investors and people living in the economy feel like things could look up in the future. So I thought it was really interesting that they made that cut before the US did. Obviously, it doesn't help the exchange rates, but we'll see how things pan out. We'll see how inflation looks over the coming quarters as the RBNZ decided to move on rates before the US. Chinese yields, going back to the Chinese point, they have not looked to stimulate the market. They have been quite frugal in that regard. And they actually created a self-demolition of their markets in 2021. And they created an environment where monetary policy was relatively tight. They were quite aggressive against equities and caused their housing bubble to also capitulate and fall over. So they weren't saving many developers, and a bunch of developers actually went out of business. And then also on top of that, you've seen less travel to China, and basically the economy as a whole has really been struggling for quite a few years now. And what that's led to, especially from the start of the year, is that their yields have been absolutely dropping at an extraordinary rate. And that really demonstrates how weak the Chinese economy is. And if the US and Europe and other parts of the world continue to also slow down, then that hurts the manufacturing industry in China. So really interesting to see the yields dropping so fast. We're also seeing a lot of concerns in the banking industry, especially the smaller banks, where the government's actually stepping in and trying to control the interest rates and the yield here. So a really interesting dynamic, definitely shows in quite an acute way where the Chinese economy is and how much it's ultimately slowed down. We will see if there is actually starts to be a change over the coming kind of 6 months. They've had a really tough time. Hopefully things pick up for the Chinese economy. Does the Chinese economy slowing down problematic for New Zealand? With the exports that we do to China, there is a lot of speculation around it having a negative impact on New Zealand. Now, the Chinese economy could actually start to level out and then eventually see some more positivity over the next 6 to 18 months. It's been a really difficult time for the Chinese economy, and therefore, obviously, it's affected our exports, which does have a drag on the New Zealand economy. Now, that to me actually says more about how do we insulate ourselves and diversify the New Zealand economy to actually take advantage of digital exports and other areas of growth that aren't reliant on finite resources, for example, farming. So I think this is more of a conversation around how do we improve the New Zealand economy from an export perspective of bits. So software, how do we build large software businesses that can serve global customers? How do we improve our financial markets? How do we allow New Zealand as a whole to become more productive? And I think that's a question that we should all be asking ourselves and thinking about how we can actually do that. And that's it for this episode of Macro Monday. As always, none of this is financial advice. It's for information and entertainment purposes only. There are no buy, sell, or hold recommendations in these podcast episodes. We're just relaying information that's already out there and available and commentating over it. So we hope you enjoyed the episode. We look forward to having you at the next episode of Macro Mondays. Goodbye for now.